So here we're going to go into what is happening abroad. What are some of the issues that we continue to see, and or benefits really, because we even though global crude on the water still remains at a seasonally adjusted all-time high, there's still a lot of unknowns, and the unknowns continue when you look at the Russia and what is going to happen with Russia, Ukraine, what is going to happen between the Saudi Arabia, the UAE, and Yemen. And that's something that we're going to talk a bit more about in the segment 1 of the Econ show, just to try to keep geopolitics over there, trying to focus on things here. And obviously, there's nothing more geopolitical at this point, especially on a commodity level, than oil. But these are some of the concerns that continue. I've been very adamant about what my views are. Going back, we've been covering the Russia-Ukraine component for months now, and trying to kind of hone in and put a cap or try to handicap what the risk is. And obviously they continue to move assets into locations. The U.S. and NATO have also been moving not only assets, but also equipment. Additional equipment continues to arrive from the U.S. and our allies into the Ukraine. There's still a positioning. The Russia still has a significant amount of assets across what would end up being 3 fronts. So just think about the difficulty of managing that on the Ukraine level. But again, they are a different country than they were in 2014, more organized, on a more prepared level, and additional equipment, especially more sophisticated equipment, has been coming in that would make any type of action deadly. And I think that is something where I do think there will be a clash. I think it'll result in some significant loss, or at least loss of life on both sides, and then that'll cause a rethink or a readjustment of what is the strategy here. Because I think when you shift it into 2 different directions, so I'll break it into my 2 normal views, and not to belabor the point, but the one where there isn't a military action. Russia wants to stop the movement of NATO east. They want to stop the movement of THAAD and other equipment into their border. So that's something that is going to be on the table. They also want Nord Stream to be approved, and they want a clear path of sale of commodities into Europe. Europe also needs a clear path of sale from Russia into Europe. So there is a political means and an economic means to do what they're doing, to make sure, one, we're still here, we're still a world power, you need to recognize us. And if you're not going to recognize us in a political manner, we will show you what we're willing to do on a military front. Now, that's one. On another, they're also showing that, with China, with some of the unknowns between Russia and China, remember back in I think it was 16 or 17, they invited China to come and watch a war games in Western Russia, and who can invade but China. So it's essentially showing you what would happen if you invaded. Now, China's also been increasing and building out more of their nuclear capacity. And this is also a demonstration of how Russia can muster, how they can do things. So there are a lot of things that they can achieve by doing this. Now, that is how things end on a peaceful note. How things don't end on a peaceful note is you'll have to have some sort of conflict happen within the, let's say middle of February. And the reason why is because there's a lot of heavy machinery, and you need the ground to be frozen. Because if the ground isn't frozen, I'm going to give you 3 guesses on where that tank ends up. So you need to be able to move heavy machinery over a frozen landscape. On the other side, remember, Ukraine was meant to be part of the U.S., was obviously part of the USSR, but as the USSR was breaking up, Russia wanted to create a union, and some similar to an EU type structure, but they needed the Ukraine to remain part of Russia in order to enforce it, to have the economic prowess to do it, which then led us to the speech that Bush Sr., former President Bush Sr. gave on the difference between independence and freedom, where you can have freedom without independence. Ukraine, as we all know, still voted for independence, and then the USSR collapsed. So there's also a certain amount of anger that the USSR, and as we know, Russia went into a deep depression, lost 98% of their economic value. So there's also you did this, you caused this pain, and there could be you know what, we're going to come back and make you pay and be back within the fold. Now, there's also reasons on why the U.S. didn't want the Ukraine to be to have its independence. The moment they declared independence, they became the third largest nuclear power. Russia held the codes, but they still held the actual missile, and there was a fear it was going to end up in the wrong hands. So then that created the Budapest Memorandum, which would, for some soft guidance or soft guarantees on borders, the Ukraine transferred all of their nuclear weapons back to Russia. So again, there's also that anger piece, and every time the U.S. has moved or NATO has moved closer to their borders, they do some sort of action. When Bush brought, I should say, during the Bush administration, we brought more countries into NATO. Russia moved into Georgia. When Clinton was talking about putting boots on the ground into Eastern Europe, what happened? But Russia moved a tank column in with soldiers, essentially. So anytime we start to get, and obviously they're getting a little bit bigger. They've had some time to prepare and obviously readjust. Nobody's economy is in good shape, especially Russia's, which also kind of goes towards the reason to do something. Because when everybody's economy is booming, you don't rock the cart, you don't rock the boat, you just let it go. But when economies start to get stressed, that's when tempers flare. People want to project the issues instead of projecting them in on the interior. So again, these are these back and forths that we have to watch and have to be sensitive to. And this geopolitical premium will remain in the system because Russia's not pulling back anytime soon. NATO's not pulling back. The Ukraine's not pulling back. So this is going to be some contention. But then obviously we had another step up in activity within Yemen, Saudi Arabia, and Kuwait. Not Kuwait, I apologize, the UAE, which is, I think, a more near-term issue where you could get some of that surprise. I mean, everybody's following Russia-Ukraine, but some of the bigger headlines are being missed or at least pushed to the side on what's happening in the Middle East, where if Russia's page 1, what's happening in Yemen, in the UAE is page 6. And I think, they should both be on page 1 based on where things are. But if anything, the issues in the Middle East could become pulled forward. But now that's more than I wanted to talk about, so I apologize. Hopefully that kind of brings you up to speed on a quick roundup. But global crude on the water, you can see it still came down a bit, and that's because crude in transit dipped, but as we had an increase in crude in floating storage, it'll still remain above the seasonally adjusted average. Again, as we've been saying, there's still a lot of crude out there, especially on the water. Now, crude in transit still at high, still above the low point of 2022. Back within the very top of the cloud. It's going to stay elevated. It's going to stay just based on where crude has been moving. But as this starts to show up, and again, we expect it to still remain well above the 5-year average, just not, a little bit of a pull down into the top of the cloud as we have more of this crude moving into floating storage, which you have here. So we're still at a new seasonally adjusted all-time high. We're above where we were in 2021. And that's something that I think continues. Now, we had that big spike at the end of beginning of February for floating storage. I just think at this point, as we've been saying, a very sideways move. As these cargoes show up, as there's a lot of crude in transit, it'll show up, go into floating storage, and we expect to see these levels remain elevated and really average out so far, as we're seeing for the next few weeks, above where they are for versus 2021. Now, when you look at the diesel crack margins are at the highest since November 2019. This is just supporting additional cargoes that are high in disti. So different types of crudes produce different types of products, or I should say different quantities of products. So the diesel crack still remains high and still going to support additional heavier crudes, which comes back to Urals, which comes back to Middle Eastern crudes, which is going to be pulled into Asia. Now the crack spread or the margin has started to come down just because the cost of crude has come up so much, and we've started to see a little bit of softening, but we'll talk about that in a minute. Now, when we look at India refined product imports, you can see imports were fairly flattish. Looking at totals, when you're looking at just diesel and fuel oil, but then when you look at exports, you can see that exports spiked in December, and that's something that we saw slow down a bit in January, but then started to pick back up, and we will see some exports increase as we get into the end of February. When we look at U.S. exports, so here when we're shifting to U.S. Crude and product exports, motor gasoline had a small increase of 19,000 barrels a day. That's still 346,000 barrels below the 5-year average. And as we've been saying, there's a ton of headwinds on gasoline in the floating market, which is going to keep that low. Same with distillate, but at the same time, like distillate demand in the U.S. is strong. Storage is low. There's really a very limited export market for us right now. You'd prefer to sell it internally, which was going to keep us well below the 5-year average. As you can see, 444,000. As we said last week, we expected a big spike in propane and propylene. I should say big, but back to either at or above. We were expecting a little bit above the 5-year average. Instead, it was just below. Increase of 163,000 barrels, getting us only 86,000 below the 5-year. Crude exports bounced another 186,000, and as we were saying, back to about 2.7, 2.8, and it came in at about 2.796. So again, right in line with what our expectations are going for the next few weeks. The WTI Dubai Spread blew out again. It's now over $4, which is just putting more pressure on U.S. exports, keeping more crude stuck, if you will, in the U.S. Just because at this spread, especially in Asia, you're not buying from the U.S. You're going to be buying more Middle East, and at that point, a bit more West Africa. Now, when we look at gasoline exports, just to give you an idea how low it is, you can see that it's new seasonally adjusted low, and that's going to remain the case for the next few weeks. Distillate, we said that there could be a little bit of a spike, as you can see, kind of that seasonal bounce. Instead, it just continued to be low, and we expect it to remain now outside of the bottom of the cloud, especially because of the harder comps. Here, when you look at ethane, as we were saying last week, we expected a bounce above the cloud. And just when we look at the average for 2022, it's going to remain and set new all-time records just because we have more export capacity and there's more demand now coming from China. Now, when you look at U.S. crude oil exports, again, pretty steady in the middle end of the cloud. More importantly is really the 4-week rolling average, which dipped a bit, but will come back up and come closer to our estimates of that 2.6, 2.7 on the 4-week rolling. Now, when we look at propane, you can see the bounce off the low. We expect this to continue to grind higher and come much closer to the 5-year average. You can see that the comps get a bit easier, so you don't need a huge increase just to get back to that average. And again, we expect this to continue to be elevated, but more so when we get closer towards March and April, as we have some bottlenecks that remain for the remainder of winter. Now, when we look at what's happening on the floating front, you can see that Russia still remains, at about 3.879 million barrels a day in Feb. We expect this to grind a bit higher. Norway's right there. Nigeria actually took down some of their estimates for the loading schedules, and it's really because we've had an increase in floating storage again, and we're starting to get a little bit. So when I talk about differentials remain tight out of Europe, out of Russia, and out of the Middle East, but they're starting to weaken again out of West Africa, which is kind of that first crack that normally happens. And who knows if the market cares, but again, something to pay attention to. When you look at Angola, something very similar, some of those slowdowns. But otherwise, things have been fairly stable across the board. Libya is increased for Feb. January is going to be a bit lower. We don't have the final numbers yet, but It'll likely either be just above 1 million or just below 1 million, given the issues that we had coming into the January. Now, strengthening middle distillate cracks, as we talked about in Europe, we talked about in Asia, also happening in Europe, is again pulling additional Urals from Asia, from other regions. So again, Urals continue to be a bright spot as European refining margins remain solid and middle distillate cracks trending at post-pandemic highs are countering the gasoline weakness which has emerged since the start of the year. This has been playing in favor of Urals, considering its typical product yield, and the Russian grade remains a crude of choice for complex Northwest European refiners. We've seen some offers get pulled, but again, still remaining fairly tight in general. The recent rally is also directly competing with North Sea grades such as Fortes and Johan, which is also supporting Urals. Again, a lot of that continuing to see that tightness in Europe and in Russia. Somo has, when you look at Somo now, Somo sold Iraqi Basra medium crude for March loading at 40 to 50 cent a premium to their grade's OSP, with sold Basra heavy for March loading at $1 premium to its OSP, both of them coming from China. So again, based on where the spreads are, you're seeing more of that buying from the Middle East, and you're still not seeing a huge amount. You saw a big increase from Angola. Angola sold out. Now you're starting to see some slowdowns from China, and you're starting to kind of pick some spots, which again is going to weigh on some of the spreads. More in West Africa right now, not as much in the Middle East. Vital withdrew its offer to sell 300 to 600,000 barrels a day of Angola's crude at $2.15 per barrel, more than dated Brent. So again, you're starting to see some of these offers go on, get pulled, and then the company offered 950,000 previously at 225. So that's where you're starting to see some of that weakness coming into West Africa. Still, again, above dated Brent, but something to pay attention to as some of these shipments adjust. There hasn't been a whole lot of movement. There's been, obviously, there's a bid-ask spread, but we're not seeing too much adjustment, and a lot of that is coming because Asia has slowed down a bit, and you get a kind of a flurry of buying ahead of Lunar New Year, then a slowdown. So that's what we're seeing here. And you're starting to see the pressure, or I should say reduction, coming from the U.S. into other markets, and additional being pulled from the Middle East. When you look at what's happening in Europe, you're getting that drop, very much seasonal normal, but just obviously at a very reduced rate. We expect this to increase and fall back within the lower end of the cloud. When we're looking at what's happening in Fujairah, total products reported a build of 54,000 barrels, and it was really driven by light distillates. As we said last week, we expected light distillates to continue to build as gasoline remains a headwind in the global market, not just in the U.S. market. The builds rose by 799,000 barrels for in storage, which is the first. Now that's the first time it's back above 5 million barrels since late December. East of Suez gasoline market found some support as China continues to reduce some of their exports, but demand continues to dwindle, which is increasing faster than the drop in some of those exports from China. Then when you look at middle distillate, still remains the bright spot. We had a big increase, and as we were saying, it's just timing. Now we have a big decrease. So the decrease was 630,000 barrels, bringing us to about 1.796 million. East of Suez gas oil market was still supported by tight supply, which again is also keeping some of, even though some of the margins have come down, still very strong, still incentivizing additional runs in the Asian theater. Heavy resid had a small drop of 115,000 barrels. Bunker market in Fujairah saw some pickup in activity, but still seeing some deliveries on the low end in terms of competitive rates. So again, we just expect resid staying fairly stable. Light distillate, again, the bearish spot, while middle distillates continue to see the big strength. Here's where Russia comes into play. Here's that big spike on the front month spreads between March and April. This is going to remain until we get some resolution. It's going to dance a bit in terms of ups and downs. So this is something that we would expect to remain elevated, but move a bit. You can see the last time it breaks $1, drops back down, and it should kind of settle between that 80, 85 cents in the near term. Here's where some of the tightening diffs caused the problem, is the drop in refining margin. So here you can see hydrocracking still remains the bright spot. That's on the middle distillate side, which is supportive even with the drop in gasoline, which is, even though we've had this drop, just to put into seasonal aspects, you can see that there's still a lot of reason that you'd be running the hydrocracker. On the Euro front, as we've seen Euros remain fairly tight, here you can see that there's still some of that softening, but as we said previously, the hydrocracking side and the distillate side still remains robust, and the same can still be said in the Mediterranean, with hydrocracking remaining the key as topping and gasoline as actually negative, but because of the need for gas oil, where gas oil sits, it is still supportive. Now, China's supertanker crude imports have increased as some of the crude that has been purchased shows up, still remaining above the average. But as we've been saying, it'll kind of ebb and flow, but we should see this increase and then come back down to, I think, the lower point for 2022, just given as things show up. Now, when we look at Asian floating storage, again, above 2021 levels, we expect this to be the case as these cargoes show up and struggle to go from offshore to onshore. Now, when we look at North Sea is at zero. We expect this to come back up a bit and just come back within, again, not to the 5-year average, but on the lower end of that cloud. West Africa, again, this is the elevated piece that we've been talking about, which is putting a little bit of pause on additional exports, just given some of the issues in moving some of these crudes. We did see some of that crude move through the system. But again, there's still a lot of capacity that they're going to look to try to push out, and they want to bring this down before you see a much bigger increase in production. Middle East crude, again, creeping a little bit higher. The drop in the widening of the spread between U.S. crudes and Dubai will continue to support Middle East. So Middle East crude. So we shouldn't see this creep any higher. Which, if it stays here, it comes down a bit. Would again support the OSP increase from Saudi. But this is going to be a big driver of how much of that increase really happens. Europe, again, a small drop. We expect this to remain at the low end of the cloud and start to move a little bit closer to the 5-year average, as we continue to see a drop in activity on China's Shandong side. Remember, they've been asked to cut about 20 to 30% ahead of the Olympics, which is starting in a week. I should say next week. So again, that's going to keep things a bit reduced and put pressure on some of that purchasing of crude going into China. So that's what we have for you today. If you have any questions, again, you can find me on Twitter in the comment section, because I always enjoy our back and forth. And if you have any questions, comments, concerns, or feedback, I'd love to hear it. So again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.